Okay, Chapter 3, Job Costing, Part 2. Okay, we just have a couple things to finish up here, and the first one is it's Learning Objective 5, and we'll figure out how to compute and then dispose of over and under allocated manufacturing overhead. Okay, so what are we talking about? This is when, remember that the manufacturing overhead is allocated using a predetermined overhead rate that's based on estimates. Okay, you do the best you can. It's not like you lowball it or anything like that. But the fact is, at the end of the year, the actual overhead will not be the same as the allocated overhead. It might be close, but it won't be dollar for dollar the same. Okay, we'll either be under allocated, where the actual is greater than what was allocated, or it'll be over allocated, where the actual was less than what was allocated. Okay, so here we have a T account with manufacturing overhead, and this is just like a temporary account that we use during the year to trace these costs around. And your actual is always put in here, so your factory depreciation, factory taxes, janitor expense, the cafeteria, indirect materials, indirect labor, they're all here in this big overhead blob. All right, then we use a predetermined overhead rate to allocate it from manufacturing overhead over into work in process. Okay, so this manufacturing overhead here is an allocated number. And here's an example. If it was under allocated, then the jobs are under costed. They didn't get enough overhead. And if it was over allocated, then the jobs must have been over costed. And the best way to do this is to use T accounts, because you can see it, because you've got a lot of over-unders and greater than, less than things going on. So you want to keep yourself straight and just think to yourself that the actual is always here on the right. Okay? All right, so the way we adjust it is we take the difference to cost of goods sold. If they've been under costed, we've got to increase cost of goods sold. And if they've been over costed, then we're going to decrease cost of goods sold. And here's an example. Here is, first of all, here's our first example where we can see the allocation going into work in process. All right, so now let's say that our actual overhead is $20,000 and we allocated $18,000. Okay, so it's under costed, right? We didn't cost enough. We've got a $2,000 debit balance here. It's under allocated. And that $18,000 would be here in work in process. So to adjust the account, we'll get rid of this $2,000, we'll credit manufacturing overhead, and we'll increase cost of goods sold, because cost of goods sold would have been too low. Okay, then just the reverse for if it's over allocated. Here my manufacturing overhead is still $20,000, but we allocated $21,000. So we allocated $1,000 more than we had in cost. So it would be over allocated. In this case, the job cost would have been too high. All right, so what we'll do is increase the manufacturing overhead by $1,000. That'll bring this to zero. Okay, it'll get rid of that $1,000 balance, and then credit cost of goods sold will reduce our job costs by $1,000. So now we'll look at some journal entries, and you would think these journal entries aren't bad at all. All right, it's actually pretty logical. This is just an illustration of the flow of costs that we've done before. The only thing that this added in here was how manufacturing overhead was allocated to jobs. Okay, it's allocated into work in process. That's what all this is. And they're using direct labor hours here. That's what the method is. And we've got indirect materials, indirect labor, and then other indirect manufacturing costs all in here in this big blob. And using indirect labor, we allocate the overhead to the jobs. Okay, then eventually this whole ball gets transferred into finished goods inventory and then out to cost of goods sold. So let's look at those journal entries. The first one, we've got they ordered and received $90,000 worth of raw material. So debit raw material, that goes up, and just credit a payable. Okay, you don't have to get fancy with the other side of these things. So you're increasing the inventory, increasing the payable. And then this for the use of raw materials, now it's going to come out of raw material inventory, move into work in process. So that's okay, right? Credit raw materials, debit work in process. That should have another there. Okay, 112,000. Then they use $2,000 worth of indirect raw materials. So we're going to, indirect raw materials. So first we're showing it coming out of inventory, out of raw materials inventory, and it's going into manufacturing overhead. Remember that when you see indirect, okay, that's indirect raw materials, and it's easy to miss it. If it's indirect material or indirect labor, that means it cannot be traced to a unit, and it would be an overhead account. Excuse me. We use direct labor. What we're doing is we're taking it out of wages payable, and we're putting it into wages payable. Okay, we owe $30,000 in wages, but rather than debiting wage expense, we're going to debit work in process. It's an inventory cost. So your actual labor is debited to work in process. Okay? You realized that before. Here's the indirect labor. Now they incurred $13,000 of indirect labor. Increase overhead, credit wages payable. And again, this is instead of debiting wage expense. Okay, it's going into an inventory account. It's going into overhead. And then they've got other plant expenses. So we've got a bunch here. And we've got $10,000 worth of manufacturing overhead. There must be some depreciation in there for $4,000, an electric bill. We got some insurance in there for $1,000. And plant property taxes payable. Better move that over. There we go. $2,000 in property taxes. Okay, so these are other manufacturing overhead costs. But the point is the whole thing goes into manufacturing overhead. And now we've got a job that used 500 direct labor hours. 603 and 604 used 1,000. And the predetermined overhead rate is $16 per hour. So 16 times 500 is 8,000. And 16 times 1,000 is 16,000. We've got a total of 24,000 of overhead. All right, so and this has been used, so we're going to take it. This is an allocation of overhead using direct labor hours, and we're going to put it into work in process and take it out of that manufacturing overhead account. Okay, I say that like you can answer me, you know. And when they're all finished, let's say the job is finished, so it's coming out of work in process and going into finished goods. Increase finished goods inventory, credit work in process. See, this isn't bad, right? It really isn't. I mean, it's not a big leap for you if you've got your debits and credits down. And when we sell it, first thing we do is increase the receivable and increase sales revenue. But the next thing we've got to do is adjust our inventory. So we'll reduce our finished goods inventory, increase cost of goods sold. So a sale has like one compound journal entry with 4 different accounts in it. Okay? You can see this all in the book too. And here are the operating expenses. These are all payables. And we've got other expenses. Here we're going to close the manufacturing overhead account. We have, let's see, indirect labor, indirect material, and a bunch of other costs. And we've allocated, so our actual costs are $25,000. We've allocated 24. Okay, so we're $1,000 under allocated. We'll increase cost of goods sold and credit or decrease manufacturing overhead, bringing this to 0. This account should be 0 at the end of the period, whenever that is. And then at the end, we've got an income statement. But that's pretty straightforward, right? It's not bad. Just, you know, you shouldn't have trouble with those journal entries. It's just increase, decrease. Okay.